Hi everyone, my name's John Mitchell and welcome to VCE Business Management. In this first series of videos, we're going to look at Unit 3, Area of Study 1, which is really looking at the fundamentals of businesses. And so the whole course is about businesses, and it's therefore important to understand what one is, which is a business is an organisation where goods and or services are exchanged for money. So it's important to note that other organisations also provide goods and services, such as a government department, but a business aims to make a profit. It's really that exchange of goods and services for money with the aim to make a profit. What they do with that profit will vary, and we'll get into that later on with the different types of businesses. But just understand for now that, distinguishing between other organisations and businesses is that they try and provide goods and services in exchange for money. Now, businesses are important for Australia and other countries as well because they provide those goods and services so that we can eat, we can have water and all the drinks, and have shelter and all those types of things that we need, and also those things that we want. But they also provide opportunity for employment, which is obviously really important with society, so that the community can have disposable income and hopefully improve their standard of living. Now, this next section is not part of the study design, but throughout the year, we're going to be talking about different examples of businesses, and we might mention the term small business or large business, etc. So I think it's just important to know what we're sort of talking about. Now, small business is one that typically employs 20 people or less. There are other characteristics that define these types of businesses or these size of businesses, but this is just the basics that we need to know, just so you know what we're talking about if we mention a case study. And a large business employs 200 people or more, and a medium business typically fits in between those numbers in terms of 20 or 200 people. Now, there are 6 key types of businesses that we need to know. We're going to split this into 3 videos because we're going to look at the advantages and disadvantages of each one. This first video is going to look at a sole trader and a partnership. So a sole trader has one person that owns and runs the business. Really common type of business where someone may have a hobby or something they really want to do, and then they start that business as a sole trader. The business name must be registered with the Australian Securities and Investments Commission if it's different from the individual's name. So if I want to start a business and call it John Mitchell, I could. However, and I wouldn't need to register that name. However, if I wanted to call it something else, I would have to register it with the ASIC. Now, a sole trader can have employees. It's really common for people to think that a sole trader is just one person, which it may be, and it often is, just having one person that runs the business and the only one that works in the business. However, they can have employees within that business, and they just need to meet the regulations of employing employees, like paying superannuation and all those types of things. Now, the individual and the business have the same legal entity. So if a sole trader starts up a business, and even if they register a different business name, that business is not different from the individual. The individual and the business have the same legal entity, and as a result of that, sole traders have what we call unlimited liability, which means the owners are responsible for the debts incurred by the business, and also if the business is sued, because the business has the same legal entity as the owner, it means the owner is sued. So let's just have a look at an example here. A tradie who's a sole trader, they may have a business account where they run their business expenses. All the money that they earn, the revenue they earn, goes through that business account as well as the expenses. But then also have their personal account, so their normal wage and bills to run their own household. Now, things are going really well. The business account has got $2,000 in it, and their personal account has got $15,000 in it. So happy days. However, for whatever reason, the business account has gone into debt, and it's now $10,000 in debt. Now, if for whatever reason the business could not earn revenue to pay off those debts, then their personal account, or the individual, the sole trader, the owner of the sole trader, is responsible to pay that debt off. And so from that $15,000, they would then have to pay the business account because it is the same legal entity and they have unlimited liability. Now, the advantages of a sole trader is that it's really simple and inexpensive to set up. The owner has complete control because they are the sole owner of the business. No disputes with partners and those types of things. Any decisions that the sole trader wants to make, they can. There's minimal government regulation, and the owner gets to keep all the net profits. So yes, they have to pay tax and those types of things. However, whatever's left over after expenses and taxes are paid, they get to keep themselves because they are the sole owner of the business. The disadvantages, and the main one, is unlimited liability. So they are personally responsible for all the debt. So there's no legal protection there. More difficult to gain finance as a sole trader, can be a burden of managing the entire business themselves. Often, as I said, there might be one person working in the business, so they're doing all the work and also managing the entire business, which can be a really big burden and often required to perform many different tasks which they may not be skilled in. So, for example, so a tradesperson, for example, may start their own business, but then all of a sudden they need to be across accounting and marketing and all those types of things, and there's a heavy reliance on the owner's own skills. Now, a partnership is very similar to a sole trader. However, it's a business that is owned by two or more people. So rather than just one person, there is two or more people, and a partnership can generally have up to 20 partners. Now, there's two types of partnerships. So we've got a general partnership, which is where the partners have unlimited liability. So they're responsible for all the debts incurred by the business, but also there are limited partnerships where the liability of one or more of the partners is limited to the proportion of their investment. So if they invest $10,000 into the partnership, then that's what they can lose. Now, it's important that partners outline their role within the business to avoid any future conflicts, so they know who's responsible for what type of decision making and what the process is for decisions, so they're not sort of treading on each other's toes, because there can become real conflict with partnerships sometimes between the partners. So the advantage is that, again, it's really simple and inexpensive to set up, but now the workload can be shared among the partners. The risk and debt is also shared amongst the partners. Although they have unlimited liability, it's not just one person responsible for those debts. It's now shared amongst the partners depending on how the percentage of the ownership that they have. They may be easier to take time off because they can and take holidays, so that one of the partners can leave and go on a holiday and the others can pick up the slack. Different skills and experience are brought into the business, and that may be the reason why a partnership is brought in, so that they complement the skills and experience that they have, and also it can be easier to raise capital, having more people providing, I suppose, money into the business, but also assets that can be borrowed against with banks and things like that. Now, the disadvantages, again, is unlimited liability, so the partners are responsible for all the debts. There's potential for disagreements over key decisions, especially if their roles aren't set out, and the liability for debts incurred by other partners. So if one partner incurs debts within the business, then all of a sudden all of the partners are liable for that, and they need to share the profits amongst the partners. Now, hopefully that the business can make more money and more profits as the partnership, but those profits do need to be shared amongst the partners. So we'll get into the others in the next video, but for questions, activities, and to find out more about our Unit 3 and Unit 4 preparation lectures, then come on over to teachingbubble.com.